Hey, it's Justin Harvey. Thanks for tuning into the Anesthesia and Pain Management Success podcast. With APM Success, we take a close look at important topics pertaining to business, practice management, personal finance, and careers for anesthesiologists and pain management physicians. We work hard to take your critical questions straight to the experts. Thanks for listening. Welcome to another episode of APM Success. This week, I'm pleased to be joined by my friend, Evgeni Ivanov, who's going to be diving into a tax topic with us today, talking about estimated payments. But before we get into today's content, a couple quick announcements. Number one, anybody who's going to be at the Aspen Conference in Miami in July, would love to hear from you and invite you to an exclusive event. So let me know, Justin at apm-wealth.com. We can get you on the list. Second announcement, I'm looking to do an upcoming episode doing a detailed compensation analysis for Kaiser employees. So anybody out there who is currently a Kaiser Permanente employee, a physician who's looking for a complimentary analysis, would love to look at your compensation, benefits, etc., and give you some feedback. We don't currently have any clients in California in Kaiser, and we're looking at California specifically. So if you fit this description and you want to have a complimentary analysis, we can talk. So email me at that same email, justin at apm-wealth.com, and we're going to use that information to create a roadmap for other Kaiser employees or people who are considering working for Kaiser who want to understand, is this worth it, given trade-offs in compensation and in the long term with pension, et cetera, what are the benefits there? So if you want to get that information as well as help your community, would love to hear from you. All right, now into today's show. Evgeni, welcome. I'm excited to dive into today's topic with you.
Hey, thanks, Justin. Nice to be on your show again.
So, estimated payments. This is something that, it's one of those things. People don't really like taxes in general. And then this is like the part of taxes that if you've only ever been W-2 employed, you've only ever had the W-40, this is like the part of tax land that gets people stressed out because they bump into it and it's new and they don't really know what it means. And then there's penalties involved potentially. So hopefully this will be a helpful primer. And we're going to be talking about who needs to pay estimated payments, under what circumstances, and what are the implications. So Evgeni, when you're working with your physician clients, who is it that most commonly has to make estimated tax payments?
Most commonly, it's the people that have any side business. It could be a K1 coming from a surgery center, K1 coming from another investment, or some kind of a side, I don't know if you want to call it side gig, like a expert witnessing, working for a company that, equipment company, anything on the side, in addition to your W-2, where there's no withholding. So that's the main point over there. There's no tax withholding paid, and you have to make them yourself.
Yeah, another place I see this commonly, especially in the anesthesia realms, with locums workers who are making 1099 income. 1099 is self-employment income. You're an independent contractor. This is unwithheld upon. The person with whom you're signing this contract is not sending any taxes to the IRS. They're sending you the whole gross amount, and you need to send money on a periodic basis to the IRS in order to keep them happy. So for folks, especially if you're coming out of training or you've only ever been in W-2 attending hood, and you're beginning to get some of this 1099 income from locums, from industry, medical, legal, consulting, et cetera. Evgeni, how do you sort of help clients of yours in this circumstance begin to understand, like, what are we doing? How does it work? What should they be thinking about?
Well, when this concept is new to clients, you have to explain to them what exactly this is. And that's what we're trying to do right now, because people are used to working with a W-2, everything's withheld, they don't have to worry about. When they go to prepare the taxes, usually they get a refund, unless, they're under withheld. But so now you have something on the side, or you start working as a self-employed, especially during COVID, there's a lot of people that were doing self-employed income, like locums and traveling nurses, etc. Then you have to take care of all these taxes yourself. So then we try to explain, not only, because at that point, it's not only income tax, you have to worry about, they call them payroll taxes when you're employed. When you're working for yourself, they're called self-employment taxes. You have the states. So there's different components there. And that's what people need to understand, because sometimes when they negotiate a contract, they don't think about the taxes that will come out of the price. And that's something you need to think about when you're negotiating your contract price.
That's right. And this can be a big shock, especially again for residents and fellows. Like the news to you is the biggest expense you're going to have basically for the next 3 decades is taxes almost every year, without mentioning a few rare exceptions. And pricing that in whenever you're making lifestyle decisions, whenever you're negotiating that contract is really important. 30, 40+% depending on your level of income can be expected. Talk about the quarterly payment schedule and how that interacts with the tax filing deadline. And if you are self-employed or you're just starting to work locums, how do you need to think about estimated payments?
Yeah, so quarterly payments, as the word says, need to be paid quarterly. But when they say quarterly, it's not exactly every 3 months as the quarters are. So the schedule, you can find it online, but it's basically the first quarter coincides with April 15th. So you might have 2 payments to make at that time, your prior year tax plus your current year first quarterly payment. Then the second quarter payment is due June 15th. The third one is September 15th, and the final one is January 15th. Now, you might have a small disclosure, some states that might be slightly different, especially at the end, the last quarter, but these are the federal guidelines, and most states use the same dates. And you calculate, there's 2 ways to calculate your payments. It's either based on prior year or the current year tax, but those are your quarterly payments and they need to be made by you. They can be made electronically or you just mail a check. Anything else right now? We'll talk about later about this, the rules of how much you need to pay, but this is regarding the schedule right now.
Yeah, so let's talk about how much you need to pay and specifically the goal. So whenever we're calculating this amount, we're not actually like the amount that you pay for safe harbor, which is a concept I want to unpack here. It's not actually the total amount you're going to owe. It's just the amount needed to keep you out of the doghouse with the IRS. So maybe explain the safe harbor tests and the way that a taxpayer can think about how much should I be paying for estimated payments.
So what the safe harbor tests help you accomplish is avoid penalties. And the rule for the safe harbor tests to avoid penalties is you need to pay either 110% of your last year tax or 90% of your current year tax. Now, this doesn't mean that you're not going to owe additional tax when you file your tax return on April 15th. This is just to avoid underestimated penalties. So the based on prior year tax is 110% on your prior year income and income tax. And this is the easier test and probably the cheaper one if you're using a CPA to calculate your payments, because they don't really need to do anything. They just take your last year's tax return and apply this rule and give you estimated payments. If you want to use the current year calculation, 90% of the current year tax, you'll have to do more detailed calculation, which can become more expensive. And people that it can depend. One might be more beneficial. Sometimes it will be worth paying the more to calculate the 90% tax. And we will go into more detail in a little bit about the two. But those are the 2 rules: 90% of current year tax or 110% of your prior year tax.
So if you're wondering how this may apply to you, I'll just give a quick example using some round numbers. If last year I was an employed physician and I made $500,000, and again, to keep it simple, I'm going to say $100,000 of my $500,000 was paid in federal taxes in this example. That would be a 20% tax rate. That's unlikely to actually happen in the real world. But say it was $100,000 for last year, for 2023. This year, I'm working that same job. I'm making the same $500,000, but in addition, I'm making another $200,000 in self-employment income. I start a side business. I'm running an online course, and I got $200,000 coming in. That $200,000 is going to create another big tax bill that I'm going to have to square up next April. But in order to keep myself out of the doghouse with the IRS, all I need to do for this current tax year is to pay 110% of last year's total. So it was $100,000 of total taxes due in 2023. So $110,000 is the total that I need to pay this year to not be in trouble. $100,000 is probably going to be paid from my W-2 withholdings if it's all employment and my withholdings are set up properly. So there's an additional 10,000 that is required to get me to that threshold. So in this very simple example, maybe I'm paying $2,500 a month every quarter, April 15th, June 15th, September, and January 15th, in order to get me to that 110% of total that I paid in. That is the 110% safe harbor threshold. Now, if I actually made $700,000, I might owe 150 or 200 grand total. So I still have to cut a check in April for that extra, $50,000, $100,000 of taxes that I owe. But because of the quarterly payments that I made along the way, that 2,500 per quarter, that is reflective of the 110% safe harbor of the prior year. That is enough to placate the IRS. Now, if we take the other sort of safe harbor rule, the 90% threshold, and you'll see why the 110% is a little easier. It's 110% of a discrete number that's already been determined, that 100 grand from last year. If I'm trying to do a 90% threshold for this year, then I'm looking at, first of all, I need to see like how quickly is money coming in. I don't know how much money I made in 2024 until 2024 is over. So you sort of need to look at your wages, look at your business profits, and kind of guess where is the 90% threshold going to be. And it's much more difficult. And in this example, because there's $200,000 of unwithheld upon income, the 90% number is actually going to be bigger. So it's, in this case, easier and more straightforward to just target the 110% of prior year tax liability number in order to achieve safe harbor. Evgeni, anything you want to expand on in that example?
Well, let me give you, these examples are correct. Now I'm going to just move forward a little bit. Let's go to year 2 of your self-employment income. And let's assume that that 200,000 actually decreases. Then if you pay safe harbor, it will be based on $500,000 of a W-2 and 200,000 of self-employment income. But you know that the 200,000 is too much. You didn't make as much. Then you're overpaying your taxes, and which may not be a big deal. You can always get a refund or apply it. But if the cash is tight, you might need that cash. So at that point, it's probably worth it to do the calculation. Hey, my income is down. Let's not pay 110%. Let's calculate the actual tax on the actual money that I'm making. So it's not easy. You need to plan, and it can work both ways. It can be more beneficial to just use the 110% safe harbor or the 90% safe harbor. It will be different each year and each individual.
That's a great point. And one of the places I see this is if someone is transitioning out of locums into W-2 employ, and in some cases maybe their total income is decreasing, but the sources of the income are changing, and they're going from W-2 plus 1099 in one calendar year to only W-2 in the subsequent calendar year. In all likelihood, that person's going to be properly withheld. They're going to achieve safe harbor by default just because they set up their W-4 properly whenever they onboarded as a new employee. So there aren't necessarily estimated payments that are going to be needed to be made in that circumstance. So in years of declining income, that's a great point. Using the 90% and really just setting up your paycheck to properly withhold is going to be sufficient. What about, Evgeni, for, say I was working W-2 and it's consistent through the year. We'll use that first example I gave where it's $500,000, so $125,000 per quarter of gross wages. And then I started a side business in Q4 that made that $200,000, but it made it all in the span of 3 months on the back end. Talk about how this creates some complexity and how you might want to think about that.
So let me give you some background. The calculation of the penalty and the estimated payments is when you prepare your tax return, the software that you're using doesn't know when you made the money. So the default is to be applied evenly through the quarters. And if that's the case, what you just said, that means that you'll be penalized for not paying any estimates for the first 3 quarters. Now, there's an option at that point to annualize your income. That's what they call it. There's on the form that calculates the penalty, there's an option to tell the IRS here, this is what I made the first quarter, which is just the W-2, the second quarter, the third quarter, and just the fourth quarter has the additional income. And that's when you pay the tax and the penalty will not apply. in that case. So that's how, when you have income that's not even through the year, it can create complexity. Now, if your income was in the first quarter, you don't want to annualize at that time, because that means you have to pay all the tax in the first quarter. So use the default evenly through the year calculation, and you might have to pay some penalties, but at least you don't have to pay a larger penalty or pay all the cash at that time.
Yeah, and just a heads up for anybody, especially if you're thinking about doing locums or self-employment or some other side business in the second half of a year. This is an area where, when I'm double checking clients' tax returns, occasionally I'll catch a problem where there are the calculation for the self-employment income is being assumed to be earned evenly throughout the year based on whatever the default calculation was that the tax preparer created. And there's inappropriately being a penalty assigned, when really, if the back end of the year is where all your locums was, then the liability should be associated over that same time frame. So something to keep an eye out if you're thinking the end of this year maybe is the time when you're going to start earning that side income. So let's look at a couple more real life examples. And this would be for, the first I'll give is a physician who is full-time employed by a hospital, but also does some locums work on the side. The salary from the hospital, this is going to be W-2 wages. They fill out the W-4. That's going to indicate here's how much withholding is going to be. That is withheld on a as pay-as-you-go basis. The self-employment work in the locums circumstance is 1099 income. It is not withheld upon. That total gross amount is going to be paid to the physician as it is earned. It will be earned evenly throughout the year in this example. Another side note here, if this is you, if you're doing that locums income, you need to keep your books, meaning like you should be running QuickBooks, or at minimum have like a separate business checking account and a separate business credit card, and be diligently tracking your expenses so that if somebody like Evgeni is preparing your taxes, they're not going to be pulling out their hair trying to figure out what's deductible and what's not. Make sure you stay organized whenever you start locums work. And then in terms of the tax considerations, if this is the first year, Evgeni, talk us through, when this client walks into your office and it's the first year of W-2 plus 1099, how are you helping them to put the tax return together, but also what are the implications for the estimated payments?
So it will depend when the client comes in. Is it after the end of the first year? At that time, you're trying to minimize any exposure and maybe just pay fourth quarter estimate to minimize any penalties. But if the client comes at the beginning of the year, then we start talking, do you have any idea how much income you'll have in addition to the W-2? Is your W-2 staying the same? Can you afford to do both jobs and still make the same amount of W-2 income? Will it have a small raise, anything like that? So if assuming the W-2 will be about the same, maybe with a small raise, then the advice that I usually give is let's not pay anything right now. Now make sure you save the money so you have enough to pay the taxes in April. Let's also monitor your withholdings. Is it going to be 110% of your prior year income? If that's all that happens, just pay everything in April with extension, or your tax return is filed. If you're not meeting the 110%, you might have to make a small estimated payment at that time to minimize any penalty exposure. But that's the first year. Then the second year, we'll start planning will be, are you going to grow your additional income? If that's the case, maybe we use safe harbor 110% based on, again, on the prior year. If it's going to be the same, there is an option. You have to evaluate the break-even point between paying more for me to calculate your taxes every quarter or just pay the 110%. Because if it's about the same, you don't have to pay 110% because that will be overpaying it. And if it's decreasing, maybe do the calculations and not pay 110% again. So these will be the planning tactics, and it's quarterly meetings. You'll need, quarterly income year to date and some assumptions, any income that you might have. So this will also include what we didn't mention, Justin, is any investment income. It's also subject to tax and there's no withholding. So you have your W-2 that has withholdings. You have your locums, as we use the example here, which has no withholdings, and any investment income will also need to be, included in the calculation for the estimated payment.
Yeah. One of the common mistakes I see is having a physician who begins locums and they think, oh my gosh, this is awesome. Look at all the money I'm making. And they either don't think at all about taxes or they underestimate the amount of taxes they're going to owe. And they see that business bank account get higher and higher and higher. And they assume that that money is all theirs. It's not a problem for the first year, at least in terms of tax penalties. But what's going to happen, what I've seen happen, unfortunately, is especially when folks engage my firm after the end of the year and they say, hey, I worked locums last year, made a bunch of money. It's like, oh, great. Have you been doing estimated payments? Well, no, I haven't. Okay. Well, it's okay on one hand because you are safe harbored potentially if you are working some W-2 as well. But the problem is you have a huge tax bill. In some cases, like a couple $100,000 or more. That is a surprise. Now, you might be thinking, oh my gosh, like it's hard to believe that there are people out there that didn't realize they needed to pay taxes, but it does happen. And sometimes it's people that thought that taxes were being withheld, and it's kind of an honest mistake, but it's a real, talk about ruin. It ruins everyone's day. It ruins my day and it ruins their day. So if you're looking at locums or 1099 income or medical legal or consulting or some stream of income that's going to be unwithheld upon, like make sure you understand, like do a little bit of digging to confirm that there are no taxes being withheld. And then whenever that money hits your checking account, what I tell my clients to do is open a second bank account, and 40% of every dollar that comes in, should be going to that other account for either estimated payments ongoing or for that big tax bill at the end of the year, April 15th.
Now, these penalties were not such a big deal a few years ago when the interest rates were lower, but now in our environment right now with high interest rates, it makes a difference. And you'll see, I don't know if you've met any of your clients, but I've had clients where they would tell me I can make more on the market than the penalties that I'll be paying. And I don't know if that's always the case. Some of them probably do it, or maybe certain years they can do it, but not every year. So some people just don't want to pay them.
Yes. And you're totally right that in the past it has mattered a lot less in terms of the actual monetary damage. But as rates are coming up, that has been one of the things that we've seen is, those penalties are getting more costly. And on the other side, if you're expecting a refund, in the past, and Evgeni, you've probably seen this, like extending usually is not a big deal. Like if, you're waiting for that last K1 or whatever, and your tax preparer is super busy. Obviously any tax preparer that I know that's good is very busy right now in tax season. But if you have to wait like an extra 3, 4, 5, 6 months to get your big 5-figure refund, all of a sudden there's real opportunity cost to not having that money in your checking account sooner rather than later. So some things to think about for your tax filing, not estimated payment specific, but definitely timing related. You want to make sure that the time value of money you're thinking about, and if you can be earning 5% in a high yield savings account, you want to do that as soon as possible. Evgeni, any other thoughts or horror stories or things that you think listeners should be aware of?
Just don't forget about them. This is what I'll say. You may not need them. Maybe sometimes penalties are really small, so we're not trying to make a huge deal about this. And just have them in mind. If as your income grows, chances are your taxes will grow as well. And it's not just income tax. You have your income on the side. You'll be paying the payroll taxes / self-employment taxes as well. Now, there's certain limitations there that we don't want to get into detail. And we have certain strategies to decrease the taxable income as well, but those are subject to another conversation.
Yeah. Well, Evgeni, thank you as always. It's been a pleasure chatting with you today on the show.
Thanks, Justin. Thanks for having me again.
If you liked what you heard this week, head on over to apmsuccess.com, where you can find more content and free resources to help you build a successful career in anesthesia and pain management. If you wanted to leave a review in iTunes, I'd also really appreciate it. Thanks for using some of your valuable time to join me today on APM Success.